Hey everyone, and welcome back to the channel. The real estate market has been a wild ride these past few years. After historic highs, many are wondering, is a correction coming? And if so, where will prices actually drop? Today, we're diving deep into that very question. We'll explore the economic indicators and market dynamics that suggest a cooldown is on the horizon for some regions, and we're pinpointing the states where real estate prices will fall. If you're looking to buy, sell, or just understand the market better, this is essential viewing. Let's get into it. First, it's crucial to understand why prices might fall. We're not talking about a nationwide crash, but rather a targeted correction in specific areas. The primary drivers for potential declines typically include rising interest rates, which directly impact affordability for buyers. When rates go up, monthly mortgage payments increase, even if the house price stays the same, thus reducing buyer demand. Another key factor is oversupply of new homes in certain markets. While some areas desperately need more housing, others might have built too much, too fast, outpacing demand. We also look at local economic conditions, such as job losses or a slowdown in major industries, which can reduce the pool of potential buyers. Finally, outmigration or a shift in population trends can also create downward pressure on prices, especially if more people are leaving than moving in. Florida. This state was a pandemic boomtown. People flocked here for warmer weather, lower taxes, and remote work opportunities. However, the sheer volume of new construction, particularly in Central and Southwest Florida, is starting to create an oversupply in some areas. Combined with skyrocketing property insurance rates due to climate change and increased hurricane activity, and rising interest rates, affordability is becoming a major hurdle. Areas like Cape Coral, Lakeland, and even parts of Orlando could see a more noticeable dip as supply catches up with or even outpaces demand, and insurance costs make homeownership less attractive. North Carolina. States like North Carolina experienced massive in-migration, particularly to tech hubs and desirable urban centers such as Raleigh and Charlotte. While job growth remains strong, the rapid appreciation has created an affordability crisis. With higher interest rates, fewer buyers can qualify for the expensive homes. We're seeing inventory levels rise, and bidding wars becoming a rarity. This suggests that while prices might not crash, a significant cooling and even small declines, especially in the entry-level and mid-range markets, are very possible as the market rebalances. New Jersey. Known for its high property taxes, New Jersey's market has always been sensitive to affordability. The pandemic saw a surge of buyers leaving NYC, pushing prices up, particularly in the northern suburbs. Now, with remote work policies shifting and interest rates climbing, the high cost of living and property taxes are becoming a major burden again. Areas that saw the biggest influx of NYC commuters might experience the sharpest pullbacks as demand wanes and affordability becomes the primary concern. Arizona. Phoenix was consistently one of the hottest real estate markets in the nation for a long time. However, the rapid price appreciation, coupled with rising interest rates, has made homes unaffordable for many locals. Arizona also saw a lot of speculative buying and new construction. Now, inventory is increasing, and homes are sitting on the market longer. Expect to see price reductions in the Phoenix metropolitan area and potentially other major cities as sellers adjust their expectations to the new market reality. Nevada. Las Vegas experienced a significant boom, driven by both tourism and an influx of California residents seeking lower costs. However, its economy is heavily reliant on tourism, which can be volatile. Like Arizona, Nevada saw considerable new construction, and the market is highly sensitive to interest rate fluctuations. Las Vegas and Reno could see prices fall as demand slows and the market recalibrates. The state's quick recovery from the last recession also means it might be quicker to correct this time around. Idaho. Perhaps a surprise for some, but Idaho, particularly its capital Boise, saw some of the most aggressive price growth during the pandemic. People flocked there for its outdoor lifestyle and relative affordability compared to coastal cities. However, prices quickly outpaced local wages, making it unsustainable. Now, with a slower national market and fewer out-of-state buyers, Boise and other popular Idaho cities are likely to experience some of the largest percentage drops as the market finds a more sustainable equilibrium. Utah. Cities like Salt Lake City and Provo saw incredibly strong demand and some of the fastest appreciating homes. While Utah still has strong underlying fundamentals, the sheer price increases made homes inaccessible for many. The market is now seeing a significant increase in inventory, and bidding wars are largely a thing of the past. This suggests that price adjustments are inevitable as the market corrects from its overheated state. Washington, specifically focusing on the Seattle metropolitan area, this region experienced intense competition driven by the tech industry. High salaries meant buyers could afford higher prices, but even then, affordability became a major issue. With tech layoffs and a general market cooldown, homes are sitting on the market longer. While Seattle is unlikely to see a dramatic crash due to strong long-term fundamentals, modest price declines are very probable, particularly in the most expensive segments and in areas that saw the quickest appreciation. Oregon. Similar to Washington, Oregon's real estate market, especially in Portland, saw significant growth. However, rising interest rates, combined with some outmigration trends and local economic shifts, are starting to put downward pressure on prices. Inventory is increasing, and homes are taking longer to sell. Expect minor to moderate price dips as the market adjusts to current economic realities. Texas. While Texas is still experiencing population growth, especially in its major cities like Austin, Dallas, and Houston, the sheer volume of new construction, particularly in Austin, has been immense. Austin, in particular, saw explosive tech-driven growth and price increases. Now, as tech companies face headwinds and interest rates rise, the oversupply in some Texas markets is starting to impact prices. Expect price stabilization or slight declines, especially in areas with a lot of new inventory. Colorado. Denver and other Colorado cities became incredibly popular, pushing housing costs to unprecedented levels. The state's attractive lifestyle drew many, but the market became severely unaffordable. With a general cooling trend and tighter financial conditions, price reductions in Colorado's major metropolitan areas are becoming more common as the market seeks balance. California. While it's hard to generalize for an entire state as vast as California, certain previously red-hot markets are seeing a significant cooldown. Areas like Sacramento, Riverside, and parts of Southern California's Inland Empire that saw massive price jumps due to people moving out of pricier coastal hubs are now more vulnerable. High interest rates are simply pricing out most buyers from these already expensive markets, leading to price corrections and increased inventory. Massachusetts. Boston and its surrounding areas are consistently expensive. However, the market saw an incredible surge in demand during the pandemic. Now, with the tech sector facing some challenges and mortgage rates impacting buyer budgets, even a strong market like Massachusetts could see modest pullbacks in certain segments, particularly the upper end or properties that were previously subject to aggressive bidding. Tennessee. Nashville, in particular, has been a magnet for growth and investment. However, the rapid influx pushed prices up very quickly. While the economy remains strong, the pace of appreciation is unsustainable. As inventory increases and buyers face higher costs of borrowing, the market is likely to see price flattening or slight declines as it normalizes after a period of intense growth. So, while a nationwide real estate crash seems unlikely, it's clear that specific markets are poised for price adjustments and declines. These shifts are a natural part of market cycles, driven by factors like interest rates, supply and demand, and local economic health. If you're a buyer, these areas might present new opportunities. If you're a seller, understanding these trends is key to setting realistic expectations. What are your thoughts on these predictions? Are you seeing price drops in your area? Let us know in the comments below. And if you found this analysis helpful, please like, subscribe, and hit that notification bell for more insights into the ever-changing real estate market. Thanks for watching, and we'll catch you in the next video.